we got another huge breakdown coming from Jack Mallers, and I believe this is the most important update we will have all year, because what you're about to learn isn't just about charts, yields, or economic jargon. It's how the US government is quietly turning the money printer back on, and not specifically from the Fed, but Jack Mallers is going to drop some blistering breakdown of the quiet monetary moves happening behind closed doors. And we're talking about massive deregulation, stealth liquidity injections, and hidden ways of inflating the market. So stay tuned.
Bitcoin is booming. Are you cashing in or missing out? At Drip2 BTC, we're rewriting the rules of Bitcoin investing. Earn up to 30% ROI on your deposits, unlock incredible Bitcoin discounts, and transform credit into up to 3,000% APR growth. No hassle, just real results. Don't wait, your future is one deposit away. Drip2BTC.com. Invest smart today.
Hey guys, welcome back. Drip Coach here with Drip and Farm for Poverty, where we don't trust, we verify, and operate with integrity and transparency. I am quickly becoming a huge fan of the way that Jack is doing his content, and again, just his simple ways of explaining things. And he's young. I think he's still like in his 30s. So the way he breaks stuff down is for folks like us that may not have a financial background or familiarity with all this stuff. And he keeps his eyes and ears to the market. I think he said his dad is 40 years in TradFi. He got into Bitcoin like super early, 12, 13 years ago, damn near from the beginning. And just his understanding of blending both of those walks of life together is, to me, kind of priceless. Like, again, I still love Raoul Pal and his everything code thesis and everything he's done, but I always like to digest other people's information so that I can filter through my own lens and have my own opinion. And I just believe Jack does a great job. And in this video, he's talking about basically, the money printer going burr. And we were all expecting the Fed to pivot. There's actually FOMC minutes coming up later on today. This is Wednesday that I'm recording this video. Jack's video came out on Monday, so you guys will see this Wednesday or Thursday, depending on when you tune in. But what's happening, and we're going to play these clips, is behind the scenes, there is basically stealth QE going on. QE has a negative connotation. Nobody wants to use it. But at the end of the day, as the Raoul Pal Everything Code says, is they have to roll the debts. They have to find a way to kick the can down the road. The entire system is built on a house of cards, all leveraged debt. And the only way to do that is to keep borrowing. Like the US does not make enough money. They have to continue to borrow. And you have to find different people available that are willing to lend such a bad creditor capital. When you're $36 trillion in debt and you're still spending more than you make each year, people wisen up, people being other countries. And they're like, yo, we're not buying your bonds. So that's what this clip is all about, is finding the other ways that the government is able to essentially inject or utilize stealth QE. So let me find those clips for you that we're going to review. This first one is talking about the supplemental leverage ratio. So real quick, if you're not familiar with the supplementary leverage ratio, it's a regulatory capital requirement that banks must maintain and to ensure they have sufficient capital to absorb potential losses. In simple layman's terms, according to Grok, it is a ratio that basically allows banks to just have leverage and take out massive amounts of debt. So for example, if the SLR requirement is 3%, a bank must hold $3 in high quality capital for every 100 total asset exposure. So that is just insane. Like, it's $3 against 100. That's nothing, right? And we're going to come out to what those numbers mean for capital injections. But first, let's play that clip from Jack where he's introducing this, and then he's going to talk about Besant giving his take on it.
Which brings me to my next one. Next, Besant, May 23rd. Again, guys, as soon as the bond market gets volatile, as soon as yields start to go up, whether it's Japan, America, all of this is tied together. It's one giant deck of cards. It's one giant highly levered financial system. Okay. As soon as that happens, you will hear immediately from all financial authorities, whether it's Jamie Dimon, Scott Bessent, Jerome Powell, Donald Trump, and we'll walk through it today. So May 23rd, as soon as these markets got volatile, it's a Friday. Bessent, I'm expecting to hear from Bessent. Here he comes. We could change the supplemental leverage ratio over the summer. Okay, we've talked about this show on the show over and over and over and over about the supplemental leverage ratio.
So that's just Jack introducing this to let you know that Besant got on live news to let everyone know. And like Jack mentioned, and again, this is, I love listening to the way he explains this, is that there is so much leverage in our financial markets that they cannot afford to surprise the markets. They can't afford the volatility, because if they're surprised, if it's super volatile, it breaks. So it is like a hair thin amount of, leverage or surprise that you can have within these markets before something breaks. So they always want to get out in front and let the markets know what they're planning on doing. So Jack was just saying that he was expecting to hear from Besant, and like clockwork, he got on the news and mentioned this. But they use this, financial speak. So us laymen's who are not familiar with TradFi don't understand what's going on. But again, Jack breaks it down. And then once you understand that, you can kind of look behind the curtain and go, okay, yeah, that makes a lot of sense. So he took a while to find the clip, and luckily I know exactly where it's at. So it's right about here.
Or U.S. late to U.S. Let's talk about the supplemental leverage
Got it. Okay. Sorry again.
ratio, which seems like an obscure thing off to the side, but it has been the subject of much discussion. And it does, as I understand it, relate to U.S. Treasuries and yields on U.S. Treasuries, so that if major banks held more U.S. Treasuries, it would bring yields down. You've said you're going to take more of an active role, as I understand it, with respect to some of that banking regulation. Where are we with that?
I think we are very close to moving the supplementary leverage ratio, SLR. That is moving along very quickly between the three banking regulators, the Fed, the OCC, and the FDIC. So I would think we could see something on that over the summer.
Over the summer, and knowing the markets as you do, would you anticipate that might have a significant material effect on Treasury yields?
Well, I think it could, because banks are being penalized for holding treasuries. There's a large supplementary leverage charge. So I think for holding the risk-free asset, we can reduce that. And I've seen estimates that it could bring yields down by tens of basis points. Certainly during the COVID crisis, it was temporarily taken off, and it had a big effect.
Boom.
So we're going to go into Jack's take on that, but that's coming directly from the U.S. Treasury Secretary. Again, letting the markets know what the plan is so that there are no surprises. But again, most of us are probably not tuning in. I don't even know what station this was on to get this information. And even if you did, you may not really understand what he's circling around trying to say. But trust me that the financial gurus, the ones that, move and listen to this, they understand what is indeed coming when this kind of information is shared. So we'll get the breakdown from Jack as well to digest.
Going to allow banks to use unlimited leverage this summer. He's telling the market again, markets cannot take surprises because they cannot take, well, not all markets, free markets can. Free markets where true humans are destined to perform can, but the legacy financial system cannot take surprises. It cannot take surprises because it cannot take leverage, because it cannot take volatility. It cannot take volatility because it cannot take leverage. Okay, he's telling you guys, I'm going to change this rule this summer. That's what he's saying in broad daylight. He's prepping the market. In fact, look at the title of the YouTube video. Besant sees easing capital rule on treasuries this summer. It's just like guys, I know the treasury market is screwed. I'm coming to save it. I'm coming to save it, and here's exactly how I'm going to save it. Here's exactly how I'm going to print the money. I'm going to print the money by allowing banks to have unlimited leverage, which allows unlimited credit. You're effectively, you're producing buying power without any actual money, right? It is money printing. It is liquidity positive. There are different forms of QE. We've talked about on the show. Their words are interesting. They can't say we're going to do QE because everyone knows QE means inflation. Inflation means my life sucks. And so if they say we're going to do QE and things get more expensive, then the American public is going to say, all right, screw you guys. It was a nice try, but I'm going to vote in the Democrats now and give them a shot. And so they have to be clever. Like even Besant saying we're focusing on deregulation because we're focusing on growth. Let's get the rules out of all these rules are constraining these guys. What's with all the constraints? Let them build. That's such a clever and interesting way to say, let's give them unlimited leverage because nobody wants to buy my dog shit bonds. Because let me make another point. At the end of the day, I think Scott Besant is super smart, brilliant trader, brilliant fund manager. I'm sure he's an awesome and nice guy. None of this is personal. But you have to keep in mind who he is right now. Who he is right now is a bond salesman. That's who he is. The next 4 years of his life, he has a boss. His boss is Donald Trump, and his job is to make sure the US government can finance itself. And he does that by selling bonds. So at the end of the day, no matter what this guy says, he's trying to get someone to buy these dog shit bonds. And so we're going to focus on deregulation. We're going to unlock the American growth by getting all these like handcuffs off of the innovators. Is a really clever way of disguising dollar debasement, inflating assets, putting us in an asset bubble by a tremendous amount of liquidity positive, unlimited leverage for the banking system.
And TLDR is that just means money printer go burr by the summertime. So that's not the Fed doing QE. And remember, I forgot the clip. It was probably from Jack as well. But Bessent said that he has tools in his tool set that he can use. And that's exactly what he's doing right now. So just because the Fed doesn't want to play ball doesn't mean that Bitcoin's not going to see all-time highs or that we won't see the liquidity train coming into the station. This is exactly what they're doing right here. And like Jack broke down, it's that, remember, you got to think of this in simple terms. The US is a business. And right now it is, for a while, it's been an unprofitable business. So if you were constantly not making profit within your business, but you want to continue to operate, then you need to get loans from someone else. And that's what the US has been doing. Getting loans from other countries by having those countries buy the bonds. Well, now those lenders, so if you think of this as yourself, it's like, okay, you go out to a credit card company, Chase, JP Morgan, whatever, you're like, I need a credit card. Then after years of you ringing up the debt, they're like, we're not giving you any more, we're not increasing your balance on your credit card, basically. You are no longer good for that. Well, you're like, okay, well, if you're not going to give me a loan, who can I get it from? So then that means you would go, in this case, they're going to internal, going to banks. That would be like you going to your family, your spouse, or something like that, robbing your kid's college fund, basically. It's like you're going internal to get the money because externally the creditors don't want to give it to you. So that's what he's talking about with the SLR. It's like, yeah, we can change that leverage ratio. And then now we're going to jump into the next piece where they're talking about Fannie Mae and Freddie Mac. And if you're not familiar with that duo, they are government-sponsored enterprises, GSEs, that play a crucial role in U.S. housing finance system. They were created by Congress to provide liquidity, stability, and affordability to the mortgage market. And you're probably wondering why that is relevant. Well, let's play that clip and see.
Okay, next. This was huge, okay? I'm giving very serious consideration to bringing Fannie Mae and Freddie Mac public. I will be speaking with Treasury Secretary Scott Bessent, Secretary of Commerce Howard Lutnick, and the Director of the Federal Housing Finance Agency, William Pulte, among others, and will be making a decision in the near future. Fannie Mae and Freddie Mac are doing very well, throwing off a lot of, all caps, I love this guy, cash, and the time would seem to be right. Stay tuned. Okay, why is this a big deal? For those that do not know, Fannie Mae and Freddie Mac were taken under the U.S. government in the housing crisis, okay? And the U.S. government absorbed Fannie Mae and Freddie Mac in their entire balance sheet after the financial crisis. Okay. There's been talks recently of making Fannie Mae and Freddie Mac a private business again, which means unleashing it from the US government's balance sheet and making it operate like a normal company, just like a JP Morgan Chase, or just like Bank of America, or just like Wells Fargo, just like another financial services firm with a massive, massive, massive balance sheet. Why is this interesting? This is interesting because the private sector would have a brand new, highly levered balance sheet to buy mortgage bonds. Okay. Basically, I've been trying to think of ways to simplify this. Think of it this way. The US government is running out of people to sell their dog shit bonds to. Okay. They need new buyers of their dog shit. So let's recap how they've been finding these buyers. One, we know about the hedge funds in the Cayman Islands, and Bessent saying he'll implement Treasury buybacks, right? Okay. So that solves for these hedge funds that are just running arbitrage trades. They don't actually care about the price of the bonds because they're just arbing. They're buying the physical, they're selling the future. It's an arbitrage trade. They need a lot of leverage. Bessent's going to provide them the leverage through Treasury buybacks. Number two is a supplemental leverage ratio. We just heard him talk about that. That is making sure that US banks can take US consumer deposits and with unlimited leverage buy these dog shit bonds. They still need more buying power. The US is in so much debt. They have so much financing to do. $36 trillion of debt. Refinancing this at 4.5% is so expensive. They need another buyer. So what do they come up with? They take a government-owned balance sheet and they puke it out to turn it into a private company that can in return go buy their dog shit. So it is estimated that Fannie Mae and Freddie Mac is going to raise $130 to $150 billion, okay? Which, according to the 3% rule, you're allowed to leverage. So I think that these guys, so I'm just going to read, a trusted macro source has done the math. At 125 to 150 billion of fresh equity plus retained earnings at 33 times leverage, which is the rule, that would give Fannie Mae and Freddie Mac, a new private company, $4 to $5 trillion of room to buy mortgage-backed securities. $4 to $5 trillion. So this is another very sneaky way of printing money. How are they printing?
That is crazy. That's like the mic drop moment right there. So it's like, not only do you have SLR, but again, this is talking with Treasury Secretary Scott Bessent. So as I mentioned before, Scott Bessent got on, national news, TV, whatever you want to call it, and said they have tools that they can basically use. And this is just another one of those tools. So you got to remember, like Jack mentioned, Fannie Mae and Freddie Mac basically got bailed out because the 2008 housing and financial crisis blew up. So they got pulled under. It's like, okay, you guys are not doing well. You're not managing funds correctly. We're going to make you move back home and we're going to manage this for you. We're going to keep a close eye on you. That's this government sponsored enterprise. So that's what happened in 2008. So for the last 17 years, they've been under the care and close watch of the government. Now, what Trump is saying, and read this clip again, he's like, they've been throwing off a lot of cash. It's like, oh, they've been doing well now. We're going to go ahead and let them go back to being public again. And that just allows them, like Jack said, to use that 3% rule that we had, but I showed you before, that Grok mentioned, that they can keep on their balance sheet, but they're allowed to take 33 times the leverage on that and then buy government bonds. $4 to $5 trillion. And I think it was Arthur Hayes that mentioned that this year, or this cycle, is going to see more money printing than we saw in the previous cycle with COVID, because it's just the nature of the beast due to the way that the debt is continuing to compound. So all those calling for the Bitcoin top and saying that we've seen it and all that stuff, like, they just really have no idea. They're not reading the writing on the wall. And that's why, again, I urge you guys, don't just listen to me. And that's why I show you this content from other people, in case you don't want to listen to hours and hours of content. Hopefully I can give you a decent summary. But all of the ones with their nose to the grindstone and actually that understand financial markets, like Raoul Powell and Jack Mallers and Jeff Booth, Larry Lepard, all these guys are telling you the same thing from different walks of life and all reading the tea leaves. So it's like, yeah, there is no logical explanation that it could go any other way but up. So hopefully you didn't get spooked out of your position and you're still in it, because by the summer, I believe we will definitely see new all-time highs for Bitcoin. Like, we've already seen them now, but I'm suspecting that 140 to 150 range by July, August for sure. And then that leads into the third quarter, fourth quarter, and probably hitting that 200K, I would assume. So I'm just making assumptions. We really don't know, but we do know that the direction is up and to the right. And that is straight from Treasury Secretary Scott Bessent. Like, they are working to get things done, and he did say by the summer. Like, I don't know exactly when the Fannie Mae Freddie Mac thing would be done, but it feels to me they're going to try to do all of this before the end of the year, so they can use all of next year going into the primaries to say, hey, look at what a great job we've done. Because you don't want to have volatility and uncertainty leading up into the primaries, or else, like Jack mentioned earlier, they'll just vote you out and bring in somebody else that basically will print the money, right? So he has to clean all this up by the end of this year. That's my assumption based on politics and seeing what's going on with this. All right, that's all I got. Hope that provided some clarity, some insight, and that you are excited for where things are going. I personally enjoy a little bit of the pullbacks and chopping sideways, because that gives us opportunity to accumulate more. But we're going up from here. All right, smash that HBO special. Help brother out. Like, subscribe, comment down below. And until next time, lift daily and achieve your impossible. See ya.